Hey everyone, Couch Investor back to another 4 stocks to buy or watch in a certain month. In this case, we're in June already, so halfway through the year, which is pretty nuts. Now, of course, this is just a video about 4 companies. There are many other companies that I could have added to the list. And maybe you've got your eyes on other companies as well. Let me know which one down in the comments below. Maybe I'll cover those in next month's video. Now, I took some companies that have not really had such a great year so far, but might have a better second half of the year and quarters to come. Some of these companies we've talked about on this channel a lot. One of the companies I haven't talked about in a while actually. And of course, I will be adding timestamps down below so you can skip through stock 1, 2, 3, and 4. Now, company number 1, pretty popular company overall, and that's PayPal. If we look at the current state of the company, you can see that it's trading at a 12.1 times forward PE. If you look at price to earnings to growth ratio in the next 12 months, 1.72, so certainly not on the expensive side. Year to date returns have been, well, negative. It's down 12.8%. In the last year, it's down 27%. Of course, the overall business hasn't been doing great coming out of the pandemic, but things are improving. And remember, at the end of the year, there is going to be a new CEO announced. Now, with all the bad news, you would have thought that, well, free cash flow would have been horrible, return on equity would have been horrible. But on the contrary, free cash flow in the last 12 months, over $5 billion. Look at return on equity, 13.3%. Gross profit margins, yes, have been coming down, but we might see some margin expansion with Braintree at the end of this year. Currently, gross profit margin 41.7% in the last 12 months. Now, if you want to look at last quarter's performance, we've covered this thoroughly on the channel. Total payment volume up 10% or 12% on FX neutral basis. Net revenue up 9 to 10%. If you look at earnings per share, GAAP and non-GAAP, big increases, big improvements there year over year. If you look at free cash flow, yes, it is down year over year, but still a great compounding business, a great business that has significant free cash flow, significant amount of cash to buy more shares, which means that your shares, if you are a holder of PayPal, are worth more. Now, I do want to add some comments here from the investors conference, and this comes from Stock Market Nerd, great Substack. It's free to follow, so I highly suggest you go and follow that. Does great summaries each and every week. Now, with regards to Apple Pay, because a lot of people are talking about Apple Pay, destroying PayPal, etc., etc. Well, PayPal saw its checkout preference and adoption rise from 2021 to today at roughly the same rate as Apple Pay. It outpaced Apple Pay in 2022, but is slightly lagging behind so far in 2023, according to Schulman. If you're unaware, Schulman is the CEO of PayPal. He says here PayPal's main source of competition isn't other digital wallets, it's other antiquated forms of checkout. 65% of checkout volume still uses manual data entry or card on file by single merchant. Digital wallets are more convenient and utilitarian versus these other options. Digital wallets will keep taking share and branded PayPal is positioned to benefit. Also, unbranded PayPal is growing quite fast. Now, of course, we would still like to see some good execution, some performance from PayPal. And that's maybe why the stock has been taking a hit recently, because the market is maybe doubting the execution right now. But overall, if you look at valuation-wise, if you look at PayPal's business, it's still growing, it's huge. And as you've seen, there's still a lot of growth ahead of it. It's a bit like e-commerce. Everybody thinks that e-commerce have reached its peak, but no, the majority of retail is still done offline. Same can be said here with PayPal when it comes to checkouts. Now, if you're enjoying this type of videos so far, leave it a thumbs up, subscribe if you have not, would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, company number 2 is one of my favorite companies that I own, and that's Airbnb. Now, contrary to PayPal, Airbnb is a bit more on the expensive side of things. If you have a look at the screen, forward PE 29.3 times. Now, year to date, the company is up, the stock is up 25%, but since last year, it's down 11%. PE to growth ratio in the next 12 months is a bit more expensive at 2.34. Now, if you look at gross profit margins, 82%, return on equity, 40%, free cash flow has been going crazy. We're going to have a quick review of last quarter's numbers. Again, we covered that thoroughly on this channel. Then revenue keeps going up. So if we're having a look at the Q1 results, revenue $1.8 billion with free cash flow of $1.6 billion, which increased 32% year over year or 471% year over 4 years, so before the pandemic started. Overall, great company. Net income, of course, is now positive, which was previously negative in 2022 and 2019. Net cash provided by operating activities increased 32% year over year to $1.6 billion. Again, a tremendous business. The stock has taken a little hit recently because, well, the company expects ADR, average daily rates, to be a bit lower in Q2 of this year than Q2 of last year, but this is driven by mix shift and the introduction of the new host pricing tools as part of their 2023 summer release. Of course, this is to be expected as they grow more in Latin America, where ADR is a bit lower, as they expand Airbnb rooms, which also lower ticket as well. Overall, you want to increase the volume, and that's exactly what's going to happen right now. So yes, ADR might take a hit in the short term, but overall, if you bring more and more volume to the platform, things will just get better over time. And they did talk a little bit about advertising. I think he said it on a podcast. Right now, advertising on platform is not really happening. In the future, pure margin. I believe this is going to add a lot when it comes to earnings per share for this company. I don't know when they'll do it, but they'll do it eventually. So don't sleep on that. Now, up next, company number 3 is a company that was heavily hated in 2022 as the stock went down over 60% or so, and that's Meta. Now, Meta has been performing quite well this year and since the lows at the end of last year. Remember, we covered this company when it was under $100. I said this makes absolutely no sense. The same thing with Nvidia, the same thing with Netflix last year. Sometimes, and with Google as well, sometimes the answer is just in front of your eyes and you're like, maybe right now is the time to be greedy when others are fearful. Now, of course, with Meta being up 118% year to date, if you look at the 1 year return, up 34%, yes, you might say, maybe it has gone up too fast already. Yes, it has recovered quite well. But remember, earnings reports were also much better than last year. Overall, this is the state of the company. I've put it from quarter to quarter now, not in the last 12 months, because it does paint the picture a little bit better. Now, if we're looking at price earnings to growth ratio, we're at 1.65. Again, being up 118% already, still not that expensive, not very cheap, but not that expensive right now. Return on equity is still 18% here. And then when we look at the numbers for last quarter, we can see that finally revenue year over year has grown around 3%. And that's on top of the fact that Reality Labs revenue has actually decreased quite a lot year over year. But we now see that advertising has been improving quite well after the Apple effect, after new Instagram integrations with Reels, etc., which we're going to have a talk in just a bit. And then when we look at operating margins, finally, we see this picking up again. The year of efficiency for Meta, cost cuts, job cuts, doing more with less, and we're finally seeing some results here. Again, still a long way to go to reach those operating margins and operating leverage that they had before, but I think they're well on their way. Now, if we have a look at what they said during the earnings call, and this is very important when it comes to AI, when it comes to Reels, etc. By the way, Meta, their models is probably one of the best. I'll try and pull up the chart on the screen here. Meta's model when it comes to AI modeling is, I think, in the top 1 or 2. So since we launched Reels, AI recommendations have driven a more than 24% increase in time spent on Instagram. Our AI work is also improving monetization. Reels monetization efficiency is up over 30% on Instagram and over 40% on Facebook quarter over quarter. Daily revenue from Advantage Plus shopping campaigns is up 7 times in the last 6 months. Now, the second part here is something that is very underappreciated from their business, and this is finally something that we're seeing improve. Our work to build out business messaging as the next pillar of our business is making progress too. I shared last quarter that click-to-message ads reached a $10 billion revenue run rate. And since then, the number of businesses using our other business messaging service, Paid Messaging, on WhatsApp has grown by 40% quarter over quarter, not year over year, quarter over quarter. Our success here depends on delivering results for other businesses and at our scale that can have macroeconomic effects. And by the way, for those that are saying that Facebook is dying, well, if you look at family daily active people or DAP in billions, well, it's still going up. It's now over 3 billion. Let that sink in. And our company number 4 is a semiconductor company. No, it's not Intel. No, it's not Nvidia either. And it isn't AMD. It's Qualcomm. Now, Qualcomm currently also doesn't have such a great year. Year to date, it's up only 6.8%. Since last year, it's down 14.5%. Right now, valuation-wise, forward PE of 13.8 times. PE to growth ratio in the next 12 months, pretty expensive. You can see the rise here. I'll explain in a bit why. It's now at 3.71. Revenue has come down. Free cash flow still $6.85 billion in the last 12 months. Return on equity very, very high, 64%. Gross profit margin, 56.4%. Now, why has the stock come down? Why isn't this company growing anymore? Well, remember, right now, when you look at the smartphone market, there is a slowdown there, right? Because if you think about it, if you're buying a phone that is worth, $800 to over $1,000, yes, maybe you don't have to buy a new smartphone each and every year. Because let's face it, besides maybe some camera improvements, nothing else changes there. But with regards to Qualcomm, they are already taking some steps for the coming years and decades ahead, a bit diversifying their businesses. Now, if we want to have a look at their numbers from last quarter, so yes, revenue was down 17% year over year, earnings per share down 33% year over year. That's why you see the PE to growth ratio jump significantly. If you look at QCT, which is the technologies, and this is QTL, the licensing one, same thing there. Revenues down 17%, QCT down 18% in QTL. And when you look at QCT specifically, handsets, so yes, smartphones, etc., down 17%, but automotive is up 20%, IoT is still down 24%. But I do want to talk about this just a little bit. So QCT AI leadership, they say they have the world's first on-device demonstration of Stable Diffusion on an Android phone. Over 1 billion parameter generative AI model runs efficiently and interactively on the Android smartphone, enhance privacy, security, reliability, and cost with on-device processing, and its leading Qualcomm AI engine, Qualcomm AI stack, and tools make it possible. Of course, this is going to be extremely important with the rise of generative AI, making sure that your phone can handle this, and not just your phone, because as I said, they're working on different revenue streams for the future. Automotive is one of it, right? Computer on wheels. This market is just going to grow and grow. But also mixed reality, augmented reality, virtual reality. We know that Meta is working very, very closely with Qualcomm for XR chips. So this is again going to help the company in the future. But on the darker side, we have some rumors that Apple might do the same to Qualcomm what they did with Intel, move completely away from Qualcomm's modems and do it all in-house. This will, of course, hurt the business like Qualcomm. There's been rumors that it's about $5 billion in sales for Qualcomm. Now remember, we're still living in a world of iOS and Android. Android still using Snapdragon. VR devices, etc., are probably also going to use Qualcomm. There are other companies out there as well. Automotive, there are some partnerships with that as well. Again, right now, yes, there is some risk to it, and I think most of it is baked in the price today. That's why you see the stock price down. But I think a company like Qualcomm, it's also paying a small dividend, so that's always nice to see. Still free cash flow positive, pretty good there. I think a company like Qualcomm could be a good choice in a long-term portfolio. There is a little bit of risk attached to it for sure. We want to see better execution in the next coming quarters. That will decide what the stock will do in the long term. And so that will be it for me in this video. Those are the 4 companies I chose to watch in June. Of course, it's always better to buy those companies, to buy companies on a red day than on a green day. Remember that, especially in the last couple of weeks, we've had a lot of green days, a lot of green weeks actually. So let's wait and see what happens with the debt ceiling announcement, etc. Can they find an agreement? Can it pass through the House? Let's wait and see. But as always, look at red days to add instead of green days. That will be it for me into this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.